In the latest economic news, inflation across the globe continues to dominate headlines, with countries struggling to manage its impact on their respective economies. In the United States, prevailing inflationary trends are seemingly hitting a plateau, particularly in the core consumer price index, CPI, which strips volatile food and energy components from the equation. The challenge is nearing the Federal Reserve's inflation target, as inflation, while easing, is doing so at a frustratingly slow pace. This pattern of unsure and uneven progress is not just unique to the U.S., inflationary pressures and their root causes are weighing on policymakers and citizens worldwide. From Argentina to Norway, South Africa to China, the range of inflation drivers points to grave concerns about government intervention, loose monetary policies, and the consequences of global supply chain disruptions. But first, let's examine the contours of U.S. inflation, since it influences large parts of the world economy and investor sentiment. Despite ongoing rate hikes and gradual disinflation, inflation remains sticky in the U.S. The upcoming October CPI results could highlight the uneven nature of price reductions. According to estimates, the CPI is expected to rise approximately by 0.2%, reflecting the fourth consecutive month at that rate, but the headline year-over-year figure might show the first acceleration in inflation since March. This suggests that tackling the last leg of inflation reduction may be more difficult than policymakers anticipated. Fed Chair Jerome Powell and other Fed officials, like Minneapolis Fed President Neel Kashkari, have cautiously hinted that the journey back to the Fed's 2% inflation target could be a bumpy one. What's troubling is the enduring pressure on core goods, a phenomenon driven by high demand for cars and auto parts, exacerbated by the disruptive force of Hurricanes Helene and Milton. Auto demand linked to storm-related damage could also explain some inflationary persistence in core goods, demonstrating the complexity of external shocks in the economy. Inflation in services has also been resistant to decline, notably accommodating hotel stays for evacuees and other weather-related travel adjustments. Economists like those at Wells Fargo describe this continued rise in core goods prices as frustratingly slow when thinking about easing inflation post-pandemic, further exacerbated by unexpected crises. Meanwhile, Powell's insistence that inflation is falling on a path despite one or two bad reports shows that the Federal Reserve is likely to stay its course with measured rate cuts. Additionally, wage growth, outpacing inflation for several months, has fueled retail sales growth. But high earnings, while beneficial for consumption, add further fuel to long-term inflation if productivity does not grow correspondingly. We're edging dangerously close to a situation where real wage gains, instead of cooling inflation via productivity improvements, are fanning inflationary flames through excessive demand. Inflationary trends are not a phenomenon concentrated solely to developed nations like the U.S. The global landscape reveals a diversity of economic troubles that highlight deeper structural issues and the inefficacy of certain government policies. Turning the spotlight to the world's second-largest economy, China's fight against an economic downturn may show marginal improvement in October when new data on industrial output and retail spending is released. The necessity for broad-based stimulus, however, shows that China is far from recovery, particularly in terms of property investment. The Chinese property sector, which contributed as much as 30% to GDP in some form, including real estate development and related industries, has been a major source of destabilization since 2020. President Xi Jinping's stimulus measures in 2023 have helped revive some aspects of investment, but solid growth remains elusive. The weakness of China's property sector and its prolonged disruption of asset markets almost feels like a chapter out of Japan's lost decade in the 1990s when years of rapid growth came to a sudden halt. A prompt recovery, as some Chinese officials hope for, may prove wishful thinking, particularly as global economic pressures build. If industrial and retail figures only eke out marginal gains, it merely underscores the fragility of China's economic trajectory, with potential to further fuel deflationary expectations within East Asia and beyond. Yes, stimulus might bring temporary relief, but long-term sustainable reform is what many analysts argue is needed, not short-term band-aids born out of political expediency. Europe isn't faring much better, with Germany, the economic powerhouse of the Eurozone, revealing deep fissures in its industrial and energy sectors. Inflationary pressures have stuck around, despite seemingly aggressive tightening from the European Central Bank, ECB. Moreover, the October PMI data for Germany suggests the nation is teetering on the edge of recession yet again, still reeling from industrial malaise, high energy prices, and global supply chain fragility. Europe also faces another looming threat, political fragmentation, with Germany facing potential early elections. Fragmented politics and fractured economic policies are a dangerous combination for an integrated zone like the EU. Although inflation decreased slowly, investor sentiment remains poor, and upcoming GDP releases are not producing high hopes of large growth upturns. Meanwhile, the Eurozone's inflation data paints an uncomfortable picture of persistent core inflation even after rate hikes. The European Central Bank has hinted at potential further intervention, but many remain skeptical about just how effective these tactics can be, with nations like Italy, Spain, and France all dealing with record levels of public debt and slow structural reform. In developing countries, like those in Africa, South Asia, and Latin America, inflation presents itself in much harsher realities. Take, for instance, Nigeria, Russia, and Argentina, all nations with drastically different inflation rates stemming from different causes but sharing a common thread: the failure of government policies to adequately address long-term structural issues. In Africa's largest economy, Nigeria, inflation has picked up to 33.4%, partly due to the government's decision to roll back fuel subsidies, a decision that, though necessary, has aggravated an already beleaguered consumer base struggling with elevated unemployment rates and stagnant growth. Similarly, Russia, widely insulated from much global trade due to its war in Ukraine and rigid sanctions, maintains inflation around 8.6% despite a 200 basis point interest rate hike in September. War budgets and conflict-driven government spending, alongside a depreciating ruble, are making it difficult for the country to meet its 4% inflation target anytime soon. This shows that inflation in Russia is less a cyclical problem and more entrenched in geopolitical disruptions. On an even more severe scale, Argentina, still reeling from one of the world's worst inflation crises, offers a particularly stark case. October figures are expected to show a slight improvement, with monthly inflation possibly dipping below 200%, down from a peak of 289.4% earlier this year. Nevertheless, deteriorating fiscal conditions, low reserves, and a history of political mismanagement have cemented Argentina's inflation as a chronic and seemingly insurmountable issue. Across the world's major economies, the inflation crisis feels like a many-headed hydra, rearing its head in different forms and resisted by different policy instruments. The limited impact of monetary tightening in solving structural problems raises the fundamental question: is inflation now more of a symptom of unchecked structural weaknesses in the global economy? In countries such as the United States, a narrow focus on short-term inflationary management through interest rate tinkering might only perpetuate the cycle if supply chain resilience, labor market productivity, and structural reform aren't addressed. The broader picture globally continues to paint the same reality: long-term reforms are needed, or central banks will remain perpetually trying to catch the shadow of previous policy failures. China may be taking that step through defensive domestic policies, but will it suffice to counter the global macroeconomic forces? As for developing countries, inflation control policies will have to be supplemented with strong fiscal discipline, institutional capacity building, and responsible use of public funds. This is especially true in inflation-ravaged economies like Argentina, where political stability will also play a key role in potential economic rehabilitation. Although glimmers of optimism shine through recent inflation reports, U.S. inflation continues to track an uneven, bumpy path, as stated by Chair Jerome Powell. Globally, however, inflation isn't just a monetary issue but one tethered to structural fragilities, political mismanagement, and in the worst cases, a never-ending cycle of crisis, as is clear from the wide-ranging manifestations of price pressures across regions. How various governments tackle rampant inflation in a post-pandemic, splintered world reality might tell the story of the next decade. But make no mistake, if central banks worldwide continue calling for incremental rate adjustments, as the global economy barrels through a maze of unresolved challenges, inflation will continue its uncontrolled march. The next year promises to test our resolve, with inflation and recessions not mere blips, but persistent obstacles born from a half-decade of cascading economic woes.